Look, I want to ask you something. You've been grinding, cutting subscriptions, eating at home, saying no to trips you actually wanted to take, just watching your account slowly, painfully slowly, crawl upward. And then one day, you open the app and you see it. 6 figures, $100,000. For like 30 seconds, you feel on top of the world. You did it. But then, and I know this feeling exactly, this weird anxiety starts creeping in. Quiet, but real. Because you start thinking, okay, what now? What am I actually supposed to do with this? And if nobody ever sat down with you and properly explained what comes next, there's a very good chance you're about to repeat the same mistakes I see all the time. The same ones that keep people stuck at this number for years. So that's exactly what we're talking about today. Here's what you need to understand right away. $100,000 is not the finish line. It's the starting line. And the way most people treat it, like a reward, like something to protect, like money they finally get to enjoy, that's exactly why 5 years later they're in the same spot. That sounds harsh, I know. But I'm not here to just tell you what's pleasant to hear. I want you to actually build something real, not just feel good about a number for a few weeks, and then watch it quietly get eaten alive by inflation and decisions that seemed totally reasonable at the time. Let's start with something concrete. Fidelity researched this and found that the average American millionaire didn't come from a wealthy family, didn't inherit anything. They just invested consistently over a long period of time. But here's the detail everyone skips. The sharp acceleration happened after a specific threshold, around $100,000. And that's not a coincidence. It's math. Specifically, it's compound interest finally starting to work at a scale that actually feels like something. Warren Buffett talked about this openly. He said the first $100,000 is the hardest, not because saving is hard, though it is, but because the math is working against you the entire time. When you have $10,000, a 10% return is $1,000. Nice, but it doesn't change much. But 10% on $100,000 is $10,000. That's more than a month's salary for most people, just showing up while you slept. This is where the game changes, radically. And here's what's interesting. The moment you hit that number, your money starts earning more than you expect. I get it. Everyone talks about compound interest, every video, every article, but I want you to understand right now why it actually matters at this specific stage. Below $100,000, you are the engine. You are the one pushing the car uphill. Every single dollar in that account came from your labor, your time, your sacrifices. But the moment you cross that threshold, the car starts helping you push. Subtle at first, but it compounds. If you just leave $100,000 in a broad index fund and never touch it again, at a historical average return of around 10% annually, in 30 years, you'll have over $1.7 million, adding nothing, just time. And if you keep contributing on top of that, the numbers become genuinely uncomfortable to look at. But here's where most people blow it, and I mean really blow it. The moment they hit $100,000, something shifts psychologically. There's a term for it, lifestyle inflation. And at this stage, it is absolutely ruthless, because suddenly $100,000 feels like permission to finally get a nicer apartment, upgrade the car, start saying yes to things you said no to for years. And look, I'm not saying you can never enjoy your money. You can, and you should. But there's a massive difference between intentional spending and just unconsciously starting to live differently. Nobody sits down and says to themselves, "All right, starting today, I'm going to slowly destroy my financial future." It just happens. Rent goes up a little, a car payment appears, vacations get more expensive, and within a year and a half, someone who had $100,000 can barely save anything, even while earning more than ever before. This is very well documented. Income rises. Spending rises with it, every single time. Okay, so let's talk about what to actually do. Because understanding the problem is only half of it. First, and most important, don't touch the money right now. Not forever, but right now the worst thing you can do is make a big emotional decision on the high of hitting a milestone. This is exactly when people buy real estate they can't really afford. Put money into a friend's or relative's startup. Jump into crypto because they finally feel like they have a cushion to take risks. Sometimes it works out, but honestly, the biggest wealth killer at this stage isn't bad luck or a bad market. It's impatience. It's the feeling that now that you have a real sum of money, you need to do something with it. Something active, visible, significant. I have a metaphor I use all the time. Imagine you've been pushing a massive boulder up a hill for years, every day, with everything you've got. And finally, you reach the top, $100,000. You're at the peak, and what most people do in this moment is pick up the boulder and throw it because they're excited and want to see how far it goes. But it crashes into something, breaks apart, and you're back at the bottom. The right move is to carefully set it on the other side of the hill and just guide it. Let gravity do the work. Because the momentum you've built is the main asset, not just the number. Practically, here's what that looks like. Step 1. Check the foundation. I know people who have $100,000 in investments but are still carrying high-interest debt, credit cards, personal loans. Anything above 7 to 8% annual interest needs to be paid off before you even think about anything else. Because paying off a credit card at 20% interest is a guaranteed 20% return. That doesn't exist anywhere in the market with a guarantee. If that debt is still sitting there, that's your first move, no discussion. Step 2. Make sure the money is actually working, not just sitting. These are fundamentally different things. A lot of people reach this milestone, and their money is sleeping in a savings account earning 4 to 5% because it feels safer. Look, a savings account is a great place for your emergency fund, 3 to 6 months of expenses. Keep it there, no question. But everything beyond that needs to be in assets that beat inflation. Because just holding cash long-term is a guaranteed way to lose purchasing power. The Fed targets 2% annual inflation. After taxes on a savings account, you're barely breaking even in real terms. Historically, broad index funds have returned 7 to 10% annually after inflation. That's where your money needs to live. Now, here's the part that sounds boring but genuinely changes everything. Account structure. Are you maxing out your 401k? Do you have a Roth IRA? Because the tax advantages at this level compound just as powerfully as the interest itself. A Roth IRA grows completely tax-free. You put in after-tax money now, and every single dollar of growth comes out in retirement clean. No deductions whatsoever. On $100,000 growing to $1.7 million, The difference between a regular taxable account and a Roth IRA is literally hundreds of thousands of dollars. Not because you invested differently, just because of where the money lived. That's not a small detail. That's a potentially life-changing difference. And there's something else that rarely gets talked about at this stage: asset allocation. Because at $100,000, the question isn't, should I invest or not? The question is, how should I be invested, and does it actually match where I am in life right now? Most people just do the same thing they did at $10,000, throw everything into one ETF and forget about it. For a beginner, that's fine. But at $100,000, it's worth actually sitting down and thinking, how old are you? When do you want to retire? Are there any major expenses in the next 5 years? Property, kids, a business? Because the strategy for a 25-year-old with no obligations and a 38-year-old with 2 kids and a mortgage on the horizon, those are different strategies. This isn't about complexity. It's about being intentional. And one more thing that happens at $100,000 that nobody sees coming. And this one is psychological, not financial. Your sense of risk changes. When you had $10,000 invested and the market dropped 30%, you lost $3,000 on paper. Painful, but manageable. When you have $100,000 invested and the market drops 30%, you're watching $30,000 disappear, on paper, temporarily. But your brain doesn't know it's temporary. Your brain sees minus $30,000 and starts screaming, "Sell, get out, stop this." And this is exactly the moment where the paths of people who build real wealth and people who constantly reset to zero diverge. The ones who panic sell lock in that loss. They turn a temporary paper loss into a real permanent one. And then they wait on the sidelines until the market feels safe again, which typically happens right after it's already recovered and the bounce has been missed. Buy high and sell low. The most common way ordinary people destroy wealth. Dalbar studied this. Over 30 years, the average investor earned around 3.7% annually, while the S&P 500 returned about 11%. Same market, wildly different results. The only difference was behavior. How do you protect yourself from your own brain? Automation. Set up automatic contributions so the decision is never in your hands in the first place. Stop checking your portfolio every day. There's research showing that the more frequently you check, the worse your returns, because frequent checking leads to frequent emotional decisions. Zoom out. Every single market drop in history ended with a recovery and new all-time highs. Every single one. If you believe that will continue, and there's more than enough reason to believe it will, then a market drop isn't a disaster, it's a sale, assets at a discount. But you can only take advantage of that if you stay in the game. There's this concept called the wealth gap, and it forms right at this milestone. The Federal Reserve's survey of consumer finances shows that the median American family's net worth is around $192,000. But the average, pulled way up by the ultra-wealthy, exceeds $1 million. That gap exists precisely because of what happens at this stage. Most people hit $100,000, make emotional or uninformed decisions, stall out, and never really accelerate past it. A smaller group hits $100,000, understands what's happening, protects the momentum, keeps investing consistently, and just watches compounding do its thing. 20 years later, these two groups are living in completely different financial realities, not because one worked harder, not because one was smarter, just because one understood the rules of the game at this exact turning point. Look, I want to be straight with you. A lot of financial content either makes this feel impossibly complicated, like you need some kind of advanced finance degree to figure it out, or it oversimplifies it down to, do these 3 steps and by Friday you're a millionaire. The truth is in the middle. The principles are genuinely simple. Invest consistently, minimize fees, avoid emotional decisions, use tax-advantaged accounts, let time do the heavy lifting. That's it. That's the whole game. But simple doesn't mean easy, because doing it requires going against some pretty deep instincts, being boring when everything around you is exciting, staying the course when your gut is screaming at you to do something, and playing a long game in a culture that is obsessed with instant results. $100,000 is a genuinely significant milestone. Getting there requires real discipline, and I respect that. But the people who treat it like a finish line, in a few years they'll be confused and frustrated, wondering why nothing looks dramatically different. And the people who understand this is just the beginning. A decade from now, they won't just have a nice number on a screen. They'll have real financial freedom, the kind that actually changes your life. So here's what I want you to do right now, not tomorrow, right now. Open up and look at where your money actually is. Is it just sitting there doing nothing? Have you maxed out your retirement accounts? Are there any high-interest debts quietly eating away at your returns? Just know your numbers. You don't have to fix everything today, but you need to see the picture clearly, because you can't navigate somewhere you've never actually looked at properly. The people who build wealth aren't the ones with the highest income or the best stock picks. They're the ones who pay attention, stay consistent, and refuse to become their own worst enemy when things get uncomfortable. You've already done the hardest part. You know what it means to sacrifice and keep going anyway. Don't let that discipline disappear the moment the number gets exciting, because the next milestones, $250,000, $500,000, $1 million, are closer than you think. But only if you treat this moment for what it actually is. Not the end, the beginning.